Good evening, everyone. My name is Paul Young. I just want to walk you through a brief presentation of the impact of deficit spending. I'll talk about what deficit spending is. I'll talk a bit about the economy, and then I'll talk about GDP and infrastructure spending. Basically, in a nutshell, what deficit spending means, you're spending more money than you're actually taking in. So the government collects tax revenue from corporations, personal taxes, different sources of income. They also then have to spend money on social programs or other initiatives that they're doing. So if they're spending more money they're taking in, that's deficits. Deficits then themselves are added into what we call as the total debt. So in essence what's happening is the more you run deficits, the more it goes into your true debt calculation. And it's your true debt calculation is a concern to governments because it measures your ability to pay that debt down over time, which means usually either you have to cut expenses or raise revenue. So that's something you need to bear in mind. The other critical factor that drives this is you're trying to grow your expenses less than GDP so that you ensure that you're not running deficits. So the key thing is sometimes you have to put some sort of stimulus in the economy because the private sector is weak. But you have to have the right balance of policies to do that. And I'll walk you through more examples as we go through this presentation. I just wanted to show you where Canada is in terms of its debt to GDP ratio because it's one of the critical drivers that countries measure themselves as towards their peers and about what's going on. Canada's debt to GDP, now this is just looking at net debt. It's not looking at all aspects of debt from the provincial, the municipal levels of governments. This is just looking at a federal level. And you can see that we're hovering around 30%, which is a good ratio. Now here's the thing that you need to bear in mind. It's half of where we were after the war in the 50s and 60s, where we're seeing a lot of investments. We've actually seen that come down that ratio, which is a good thing. Now, what drives the economy in terms of when you look at GDP? Well, 2/3 of everything that's driven in Canada is driven by consumer spending. So the more you spend money in the economy, the more it sends ripple effects down through everything from business investments through taxation dollars. Now, the critical aspect here is if you bring in policies, whether you bring in a new carbon tax or bring in a new payroll tax, that impacts consumer spending because if they have less disposable income from a higher tax, they're going to less spend money in the economy, which will hurt the economy over the haul. If you bring in carbon taxes, that adds a new additional cost to those goods. That makes those goods more expensive. That allows them people to purchase less of those goods. That will also impact consumer spending, which is not discussed. Government spending plays a key role because they are providing the social programs to put money into the economy, into the flow. But you have to have the right mix of government spending to make sure that it's doing the proper things to support social programs. Business investment also drives GDP. So if they're investing in the country through capital or inventory buildup, you're going to see that. Now, exports and imports are critical aspects of any sort of economy, but how they measure it is the net impact. So if you're running periods of deficits in trade, then it'll actually drop down your GDP when we look at the expenditure side. Now the key aspect for Canada's case is they need to expand exports. Exports is critical because we're only a country of 35 million. We need to have that capacity to expand exports, and that's really critical. I just wanted to show you here in terms of what EDC, which is Export Development Corporation, is looking for in terms of exports and the trends. And if you look up there, you're going to see some key sectors like energy. Energy is about 24%. As much as people want to say we want to get out of energy, it's still a significant portion of our exports, and it's going to drive other aspects of the economy. So we can't just say we're going to get out of energy because we can't. We're a natural resource based economy. That's how we drive things here. It drives the money that can go into other programs to support the economy at a grander scheme. But you're never going to hear that debate or discussion talk from the ecologists or the pro-green agenda people because they're not interested about that. They're interested in moving their Agenda 21 forward. So not going to really talk about how you're going to replace that GDP lost if you decide to get out of exports. I just want to show you an example here that basically shows you the expenditure of GDP, and I'm using a $30 billion deficit projection that they're talking about in the stimulus. That's likely for the next 3 years they're going to put about $100 billion into the economy. That actually will work out about 1.5% to GDP, so it'll make GDP artificially high. Now the critical aspect is if their goals are to support construction jobs, business investment, yes, those are good investments, they're key to do. The key aspect of it is they tend to be temporary because once you build these projects, those jobs are gone. if you can't use them to expand infrastructure that supports expansion of exports, because exports are basically 25 to 30% below the threshold where they could be at, if we have the capacity, either the business investment, that's foreign direct investment, or if we had the ability to get our goods to market. And that means the pipelines, that means the roads, that means the port development from the infrastructure reports like Winnipeg, inland ports, or ports like Sydney, Halifax, Montreal, Prince Rupert, Vancouver, other ways to get our goods to market. That's critical. The other thing too is they have to be self-sustaining projects. So if they're transit, then they have to be able to basically self-sustain themselves in terms of creating profit and create the positive cash flow. That's something that's not discussed. I'm all for clean technology, but I'm all for a balanced approach. We shouldn't just go all at once in clean technology. It has to be a balanced approach to what we can do and make sure that business is supportable, that can stand on itself without subsidies. Now these are critical things that a lot of cases mainstream media will not talk about, or even if they do, they talk in very much at a high level view, but never the specific details that will drive potential negative impacts to the economy. Thank you.